Well, I know my viewers here love the technical side of things. So this video is going to be about a chart pattern. That chart pattern is going to be called the double bottom. So I hope you enjoyed the video. Hope you take some notes, and you can download my free price pattern guide. And you know, I'm not going to be modest about it. It's helped a ton of traders in their quest of becoming better traders, and I've had a lot of messages about it. So thank you for those that have touched base with me. So let's talk about the double bottom pattern, and it is a reversal pattern where we're looking at a downtrend that could be evolving into an uptrend. They could also be used as a continuation pattern if it shows up during the corrective move of a market. And of course, they're going to be present in a trading range as well. So let's describe it, and let's design a logical trading strategy around it that takes into what this pattern represents. So first off, what is it? Well, the best way to define and identify the double bottom is actually just to think of what the name is. Double bottom. Price forms one bottom and then another one. Let's take a look at this Forex chart here. The double bottom is a bullish reversal, so we need to see it occur after an extended downtrend. Time frame is irrelevant. Now the first low here is where price finds support. The market rallies. So the market rallies, and a lot of people think the trend is going to continue, and they sell the market. Well, price comes into the zone around the first low where it acts as a support level. Hopefully, price rallies up, breaks the potential resistance line at 3, and I say potential because it did not act as resistance. And in a perfect world, price breaks the resistance, the downtrend is officially over, and we have a new trend forming. Well, why do we have a new trend forming? Well, a downtrending market makes lower highs and lower lows. So if we break number 3, that would be a higher high. And that begins the definition of an uptrending market. So in reality, we could be looking at a rally in price that is set to resume the downtrend as well. So how do we trade it? And there are several ways that you could choose to trade it. And the trick is to find one that you like, you're comfortable with it, stick with it. So I'm going to give you several options in terms of trading strategies. You pick the best one for you. And one thing we should decide on is if we're going to be playing for a short-term trade with limited expectations, or are you going to be looking to ride a new trend? Because the difference is how you're going to manage a trade. And again, that's something I can't answer for you. You're going to have to decide that for yourself. Now, when trading this, some people will suggest a moving average, while others will suggest a channel. Trendline channel, Keltner channels, Bollinger Bands, and others. Well, my favorite is a channel, specifically a volatility measure such as the one that the Keltner channel provides. Well, why? Well, because if I'm going to trade a reversal pattern for a longer term, I want to see some sign that the market is overextended. And we're going to get to the Keltner channel strategy later. So the first one is a pre-breakout double bottom trading strategy. So we can expand on this by playing the basing under the neckline or the breakout of the neckline. But what's basing? Well, basing is when price is forming a small range just under resistance or above support if we're looking to go short. So price is in a downtrend, forms a double bottom pattern. As price travels up towards resistance, it stalls under resistance and it bases, and that's the green circle. Now traders can place their order to go long prior to the breakout inside the range that forms. So the stop, which is the red dashed line, would go a distance below the base. You can consider using an ATR or a structure. And if you notice, if you draw a line to the left from this stop here, it's in the area of former support. So if you use this method, you would be in the trade prior to the breakout, which can, when momentum steps in, if it steps in, can give you some pretty quick profits. Traders can also dial into a lower time frame, look for bullish price action such as a failure test to enter the trade. What a breakout over the neckline. This strategy would have the double bottom form. Price will break out over resistance, and traders would look to position either on a pullback in price or just a pause in the market. And you'll also see that previous strategy we just talked about, the basing, set up just below the red dotted line. So price breaks out, forms a one-day range. On shorter time frames, which is multiple time frame trading, this will highlight this a lot better, but you can still infer the lower time frame price action by this candle. Stops would go under the base that formed earlier. Price coming back inside the breakout level does not equal a false breakout, regardless of what people say. It makes sense that sometimes price will come back in, but price would have to remain below resistance in order for that breakout to be false. And you can see in this example here with the green circle that price did pull back into the breakout price zone. Now there are dangers that the breakout will not range until further up in price. This would extend your risk needed for that trade, and it may be a trade that you just simply miss. If you wait for a pullback, price may have traveled a far distance before the pullback occurs, which could demoralize further buyers if price pulls all the way back. And this pullback here took almost a month, and obviously not all are like this. The divergence setup. This strategy is going to use a bullish divergence signal in addition to the double bottom. You can use the RSI, stochastics, or my favorite indicator, the MACD, the MACD. Now, bullish divergence will show the indicator making a higher swing low, while price makes a lower or a same level swing low as the first one. Now, there's a lot going on in this chart here, so I broke it down with a little more detail. We compare the two lows, and we note that the second low is lower than the first. So this is a lower low after a lower high, which is still a downtrend market structure. The MACD, which is actually the 310 oscillator settings, it shows that momentum on the lower low is actually more to the upside. That is bullish divergence. A simple trend line break can be your entry by setting a buy stop order just above it. Here's an important note. Because you entered right at the lows, ensure that you monitor price as it approaches the top line. If price bases, you can move your stop to where you'd place it if you were trading the basing strategy. And if you note price is losing steam or you see a failure test of the highs, you may want to lighten up the position or just take some profits. Now, the big plus to this trade is that you do get in at a price level that's favorable before it tests resistance, which will allow you to do some trade management. And if price breaks out and runs, you're going to make some quick profits. The fake out strategy. This one here, this gets you in right at the bottom of the pattern. So the great things about this strategy are that you get in right at the low, price breaks out to the downside, it rejects lower prices, trapping traders short. And traders will exit their short positions by buying, which propels your position into profit. Now, the big difference in this strategy is that we're looking for a strong rejection of lower prices. And that bar or the candlestick that shows the rejection is your entry point. The break of the double bottom resistance level is basically confirmation. So what sets this apart is that you're looking for a spike below the previous low and a rejection of lower price. You then want to see a close above that support line. And you can enter a buy stop above the rejection candlestick. And as you can see here, you benefited greatly from this trade. So why do you look for a test of the lows and the rejection? Because failure to have price acceptance of lows can force the short breakout traders to get out of their positions. And panicked traders, they can be like throwing gasoline on a fire. And to find this type of rejection, consider adding a double bottom multiple time frame approach as part of your trading plan, because there will be times that the close may be far off the lows if you wait for a daily candlestick to close. Now, the Keltner confirmation. You can watch more videos or a video about trading the Keltner channel here, the links above. And I think it works really well with the double bottom. So in brief, Keltner channels are going to measure the volatility of the market. And the upper and the lower bands will help show where a market may be primed for a snapback in price. So this market here has been a downtrend on this 60-minute chart for about 2 weeks. And one thing to note is when price travels on the outside part of the Keltner channel, we're actually looking at a pretty powerful trend. And being strong in the one direction means there's quite a lot of downside interest. So when it breaks, it can be pretty severe. But what we need is to have an idea or some sign that it could break. Enter the double bottom pattern. So price puts in the first low outside the band, and that's not needed. After a lazy retrace in price, price shoots to the downside, pierces the band. And in this case, it also sets up that fake out strategy with the Keltner confirmation. You can enter at the close or use a buy stop above the rejection candlestick. This is a strategy I highly suggest you test out for a possible trading plan for yourself. So where do we exit? This is kind of a touchy subject because the reality is that you could be looking at a brand new trend forming. That's really a trend follower's dream, but a lot of you probably will not be able to stomach a whole lot of adverse price action against you that trend followers have to go through at times. So a rule of thumb for profit taking for any chart pattern is to look at the height of the double bottom pattern. In this example, project from the breakout. So this is the same chart from the Keltner strategy. And you project the height of the pattern from the resistance to the lowest low of the pattern and project that from the resistance. And you can see that price here is well on its way to the profit target. And you can see that the price is well on its way here. And this particular trade, if it worked out, the risk reward ratio is 1 to 1.68. And you can also use trailing stops, and you can watch a video about trailing stops at the link above. So let's wrap it up with some pretty vital points. And these are some keys to not only identifying the pattern, but trading it. So you want to make sure you have an obvious downtrend in the market and the time frame that you're trading. You want to look for price to put in a low and retrace to form a resistance zone. The second low does not have to be at the exact price as the first low. And we're looking for signs of rejection. Trading before the resistance break is aggressive. However, we are using other factors such as the Keltner Channel to tip the odds in our favor. Ensure you place, respect your stop loss. And this is a pattern that you can quickly scan for. And using the Keltner Channel is a highly effective way to zero in on a trading opportunity where the odds are actually in your favor. Like all trading strategies, ensure that you test this out and make sure that you have a trading plan put together and you follow it to the letter. Thanks for watching. Hit subscribe, send me a comment if you like, and we'll talk to you soon.